and gas for tax efficiency and how AI can help you evaluate and understand these kind of investments. I'm Priyanshi, product lead at Alfonso. We are a wealth management platform, a registered investment advisor, a flat fee, one-stop shop for all your tax, investment, planning, and estate needs. I'm joined by Rupesh, our lead advisor, with more than 13 years of experience in portfolio management, having managed more than $300 million portfolios. And of course, we are lucky to be joined by a great set of audience. Today we have software engineers from Chime, Databricks, to directors at Meta and Google joining us. We have people from New York, SF, Austin. We also had registrations from people right now in India, which is crazy time, but thanks a lot for making that. Welcome, everyone. And as the year end approaches, two of the biggest problems that we are seeing with people around us, especially those working in tech, is struggle with one, the big tax bill. It's December and we're wrapping up the year soon, and we're going to, make any changes that need to be made to your tax bill that can be made to make it more efficient, can be now. We're looking for ways to offset it. And B, a heavy concentration in tech portfolios, again, especially for people working in tech. Today, we'll be covering the topic about a sector not so commonly known. So by the end of this session, we know what oil and gas investments mean. And even if you already know about the sector, you might be keen to learn about the nuances of how it can be utilized for tax optimization, for evaluating risks, returns around it, and diversification. So with that, I'll pass it to you, Rupesh, to help us walk through what these investment strategies mean and what are the best ways to evaluate a fit with them. Just a logistic thing before that. If anyone has questions, feel free to drop them in Q&A. Some of you already sent out your questions over email. So we will have 45 minutes here, of which 30 minutes we'll go through the webinar. You can keep dropping in your Q&A. And then in the last 15 minutes, we'll cover starting with the emailed questions first. So thank you. Welcome again. And Rupesh, the floor is yours.
Thank you, Priyanshi. Thanks a lot for joining in. So when we talk about oil and gas investing, it's important to understand where it actually fits in the broader market. The S&P 500 is divided into 11 major sectors. That includes your technology, communications, healthcare, industries, and so on. And one of those sectors is also energy, which contributes to roughly 5% of the overall S&P 500. And within energy, we have companies involved in oil and gas productions, energy minerals, drilling services, and the infrastructure, which is very important to keep the energy system running. So in crux, if you are investing in oil and gas, you are not actually investing in a niche. It's just you are investing in one of the core sectors which actually drive the US and the global economy. And it gives, and given its importance, the US government has actually offers a preferential treatment in form of tax deductions for investing in special instruments like this. The reason, again, US incentivize oil and gas investments within the US, and the move is not just financial, it's actually very strategic as well. These policies are actually designed to strengthen the national energy needs and security and reduce the dependence on foreign oil. Naturally, the more domestic production is there, the less vulnerable US is to actually global disruptions. So what government does is it encourages private capital to fund these explorations and development within US. And instead of using actual taxpayer money to fund these projects, they actually reward investors who help export and expand these domestic energy outputs. So the question now comes in, why now? So this is something that has been going since 1986, but it's even more attractive in today's world. And that's because by 2030, the global data center electricity consumption will more than double compared to what it is right now, which is fueled by the AI. And because of this, many new planned data centers are actually powering their capabilities and are relying on these resources like natural gas and oil. And there is an analysis that suggests that the production actually needs to be increased by more than 10 to 15% annually to keep up with the demand over the next 5 to 10 years. On top of that, the geopolitical uncertainty remains with Russia-Ukraine conflict still in the Middle East uncertainties, and the deglobalization trends that we have seen that has caused trade restrictions, which all kind of contribute to the price volatility more on the upside for these instruments. So what's in it for you? So there are three key reasons for someone like you to kind of get into this particular side of investment. The first one is tax deductions. As I said mentioned before, there is a preferential treatment for by the US government. So there is a possibility that up to 100% of your investments can actually be used in complete tax deductions in the year which you kind of invested, which reduces W2 significantly, W2 income. The second, given the income stream, so given the demand and the income generated from oil and gas all through the production, it could be a significant boost for your passive income, which could last for more than 20 years. In addition to that, 15% of that income is also tax-free, which is again moved by the US government to incentivize oil production. And lastly, it provides additional diversification for someone who is, let's say, invested in just S&P 500, as there is a correlation between oil and gas prices and S&P 500, and to folks who have, like, let's say, technology sector concentration or the individual investments through their, let's say, RSU or their private investments. So how do you kind of get into the investments? So there are two ways to kind of get into this investment. And stepping back from, let's say, regular stock market investing, there's actually a way by owning the rights of the resources beneath the lands which generate something like this. Things like oil, natural gas, and minerals. So in terms of passive ownership, how it works is you actually own the rights by purchasing the lands. And from there, the long-term value really kind of begins in, which is in form of royalty payments. So these royalties are generally paid in the percentage of the revenues that are kind of generated from these lands through oil and gas production. In other words, every time oil and gas is produced and sold, the royalty owners get the payment. One of the biggest benefits of this particular structure is the prioritization. Royalty owners generally are paid well before anyone else in the entire project. And when the well is producing, the income can last very long, from maybe 10 years to 35 years. Although the one trade-off that you need to be aware of is the royalty income actually doesn't come with tax deductions. So unlike working interest, which we will be talking about, you're getting more like a secure seat in the payout structure, but without any significant tax write-offs. And that is why the focus will be more on the active ownership, which is the second form of ownership within these projects. So within these type of investments, an investor participate directly in the cost, the risk, and the revenues of the well, which is generating this oil and gas. That means when the production is strong and the oil and gas prices are high, the upside is very, very significant. But because you are directly kind of involved in the project economics, you're also sharing the costs associated with it. That could be operationals or management or any other financial kind of exposures. The income generated through these structures is based on the net production of the revenue. So it will be after drilling, you sell these oil and gas, and then you deduct expenses, and the remaining is kind of distributed to you. And once, let's say, the well become productive, it again continues the income stream for around 25 years on average, and the range is 10 to 35 years. And one of the major benefits for this structure is the US tax treatment, because the investor here is considered an active participant in domestic energy development. Although they're not doing anything, just providing the investment, the investment amount is completely tax deductible. For many investors, that means reducing their tax income in the first year and meaningfully boosting their after tax returns on a project like this. So now let's talk about how what this kind of project looks like. So the typical project size of something like this is generally on a small scale, which range from investments from $10 million to $50 million, obviously depending upon the geology and then the scope of the drilling. There are generally multi-wells designed for something like this because they want to diversify. They don't want to go for just one well and kind of start the production. So typically there are like 2 to 5 wells within the project, and that kind of maximize the output. And obviously shared infrastructure is kind of taken care of to kind of build some scale around the costs as well. And then there's a balance of production from these particular wells, oil and gas, which could be 50-50, 60-40, 70-30, based on the geology. The target returns generally is very high in the initial years, so you get maximum output. So of around 30% or more, even more in the first 2 years. And then obviously there are upfront tax benefits that are associated with it as well. And then in terms of the long-term cash flow, it typically ranges from anywhere from 10 years to 35 years based on, again, the geology of the well. So now let's quickly walk through how the life cycle of the complete well and this drilling investment look like. So it begins with the exploration of the drilling phase. From the moment the project is kind of launched to the time the well starts producing, the timeline is usually 9 to 12 months. During this period, the drilling team will prepare site, they would mobilize the equipments that are used, and drills the well to the target formations. Financially, this stage comes with two key kind of tax components. The first one is intangible drilling cost, which includes things like labor, fluids, fuel, and site preparations, and then obviously salaries. These are actually not deducted once, but these are typically tax deductible, and 100% of them are actually deducted on the year which they occurred, which is a significant boost to the tax investments. The second category is tangible drilling cost. So this is your physical equipments, your casing, and your actual hardware that is used for drilling. They're not tax deductible at once, but they are kind of depreciated over 5 to 7 years of their lifetime. So after the drilling is complete, the wells are now simulated. The project moves into the production phase. This is where it gets exciting for investors. Oil or natural gas is extracted and sold to either refiners or distributors, and the revenue generated is shared with the investors. This phase can last from anywhere 10 years to 35 years, again based on the geology of the producing well. And lastly, the third phase is the ongoing operation. Throughout the production, the operators on the field actually handles everything like day-to-day well management, maintenance, compliance, reporting, and sales of the product. As an investor, you don't have to kind of manage the operations. You just simply receive the revenue distribution, and then obviously the transparency in terms of communication, in terms of how things are kind of going on the site overall. So let's take an example of Mike. So he's married, he's living in California. He has a combined household income of $700,000. That puts him in roughly 49% tax bracket with 37% federal because of the income over 500K and 12% roughly in California, which means nearly half of the every additional dollar he kind of earns goes to the taxes. So for someone like Mike, tax efficiency can be very, very beneficial and can have a massive impact on net returns. So let's say he kind of invests $200,000 in a tax advantage oil and gas structure. And over 5 years, what he's going to now see is he's going to generate $70,000 roughly in additional gains if you were to kind of invest in, let's say, general stock market. And when we zoom out kind of projected lifetime for project like this, it can result in more than $400,000 of additional gains. The power here comes from both, compounding the royalty income and the ability to kind of offset this active income with energy specific tax deduction. As you can see here, 200K in year one would generate $98,000 in cash flow for this particular user. And then throughout the life period, the compounding effect kicks in and the user keeps on getting income and beat, the general investing if you would have not kind of invested in the market. And finally, the last in the year 20, you can see the value of actual asset is 1.4 million roughly versus 1 million if you were to kind of invest in a regular market. So in terms of how you now evaluate any kind of investment like this. So when you look at the working interest of the project, I mean, if we were to kind of look at from our angle, we just don't look at returns first. You look at the quality, you look at the star operators, you look at their years of experience, you look at the track record of the wells they kind of drilled, their infrastructure reliability, and average cost of overruns versus actual plant. You also need to kind of review equipment age, drilling time efficiency, and management kind of tenure, which kind of all directly translate into the project performance overall. Next, when we kind of move to the reservoir and production history, we generally need to kind of compare average production versus typical kind of curve expectations, their historical well success rate, and then those are kind of mapped into the production decline against, let's say, P9 production curve and break even kind of price bands. Strong geology can withstand weak markets, but weak geology cannot. So you got to kind of be very, very prepared in terms of how the site looks like overall. And then we kind of analyze the overall project structure as well, look at the percentage of working interest, dilution likelihood, lease timings, royalty burdens, joint venture exposures, and the overall partner reliability who are kind of into these operations. Even great wells can actually struggle if the structure is kind of poorly negotiated overall, which affects into the overall return performance of the project. And finally, we run the economics, which is all about then maths in terms of cost per foot, net revenue interest, return on investment range, and the tax benefit ratio an investor would get. So these factors determine not just how much the project could actually make, but how much an investor actually keeps after expenses and taxes. And we know when all four of these are strong, the investment is right. So now let's get into the angle of how actually AI kind of comes into something like this. Uh, so we have like thousands of oil and gas firms and thousands of projects that needs to be analyzed without any biases and overall. So how to kind of approach something like this? So the answer to that is AI. So large language model are now used to kind of parse complex operators, reports, lease documents, engineering statements, financial summaries, making it possible to compare these projects objectively across dozen of criterias. Then after the data is kind of organized, the machine learning models can evaluate each project using quantitative factors such as commodity price sensitivity, projected production output, declining curves, break-even economies, and long-term income simulations. This enables rapid screening of the opportunities and highlights projects that align with historically strong performance characteristics that are needed to generate high IRRs. And lastly, it's the personalization aspects. Project can be matched to the investor's profile. What kind of project would be basically aligned to the investor needs, whether the person is looking for active interest or they're looking for more like a passive interest with very, very kind of low risk. What they're looking for small single site well projects, or they are looking for more diversified well projects. So these kind of factors also matters whether they are kind of looking for more tax optimizations or less tax optimization or more diversification. So these are the kind of things that one needs to kind of take care of before getting into a project. That helps them kind of understand the overall dynamics as well as the economics of the project. So what are the key risks? Nothing comes for free. There are always risks associated with it. The first one is on the liquidity side. So once someone kind of invests into a project like this, it takes 2 to 3 years for them to kind of recover their money completely. And then obviously income starts to generate on top of that. So for someone who needs, let's say, X amount of money, here, take example of Mike, if he were to kind of need those 200K to fund maybe his college education or his startup, this may not be the right opportunity for you because your money is kind of locked for that particular 2, 3 years period. Obviously, you get the tax benefit straight away out of it, but the remaining takes time to kind of start the production. Like any other investment, it is also subject to risk. So your stock market is generally investment risk. There is a risk of markets there. Here, the commodity pricing are kind of subject to risk, and that kind of affects the project in a certain way as well. With higher the prices, more the kind of income, less the prices, obviously less of the income. The project risk could also be there, although highly unlikely. Any major catastrophe like natural disasters, oil and gas spills can affect the returns and delay the investment returns to you. And then finally, the regulations. While the upfront tax benefit will always remain, or at least for this year, as you kind of invest, the 15% tax-free income that you generate from the investments is subject to regulatory change anytime, although it hasn't changed in 40 years. So lastly, if you are more into the sustainable side, you don't need to kind of look at oil and gas as just like all bad. So if you look at very deeply in terms of how things are kind of there, it's not as bad as it kind of looks. The reason is the global energies reality is that the renewables alone cannot actually meet the rising demand yet. Even the most optimistic projection shows that it will take decades and decades to replace the fuels like oil and gas entirely. Until that transition is complete, the world still needs oil and gas for transportations, heatings, manufacturing, and even the components used in solar, wind, and EV supply chains. So our thinking is, if you want to kind of invest in certain instrument, you got to look for responsible production, which is better than irresponsible production. So how it works is, let's say if energy is still kind of required, it should come from operators that follow very much and sustainable practice and which are kind of monitored very, very thoroughly. That includes sustainable drilling standards, minimize methane releases, strict ESG protocols, community building in the area where you are doing the drilling. These kinds of things kind of make you a more responsible kind of producer. And then you would be amazed to know that actually modern drilling operators are also a gateway to key ingredients like lithium and rare earth minerals, helium and clean hydrogens, and petrochemicals, which are all required for today's renewable infrastructure. So, just to kind of summarize, so how do you make money? So, as I kind of discussed, the first aspect of this particular investment is intangible drilling cost, which is 100% tax deductible. So, whatever you invest, that's kind of going into your tax deduction by reducing your, let's say, W-2. There are like other aspects of this investment as well, like TDC, which is tangible deductions, which are tax deductible, but they're over their period of life, which is around 5 to 7 years. A typical project would have more than 80% of IDC and 20% of TDC. And then on top of that, you have the strong income generation from oil and gas production, and 15% of that income, which you kind of generate, is tax free over the life of the well. And income generation from selling an oil gas can range from anywhere 10 years to 35 years with an average of roughly 25 years. And if you are kind of working with your advisor, most likely you would be kind of already knowing about it and working on it. This is the kind of framework you need to kind of look at and seek before you kind of get into any particular investment. Now I would like to pass it over to Priyanshi, who can tell you more about how can you kind of learn more about it, these investments, and any questions that you may have for us.
Thank you, Rupesh. We're right on time. I just wanted to mention that if you have questions for the next 15 minutes, we'll be covering that. And I just enabled questions for all. So you can share your questions in the Q&A button you see underneath, and everyone will be able to see your questions appearing there. If you want to do a deep dive, there is a QR code that you can scan and book a session with Rupesh to go deeper into this topic on how you can personalize oil and gas investments for your own needs. We will start with a question posted here on chat. Rupesh, Trump administration is trying to bring the price of gas down and devaluing dollar, resulting in inflationary future prospects. How does oil investment look like in this picture?
Thank you. That's a good question. That's the kind of reason they are kind of also encouraging investing in oil and gas with taxes. They want to kind of bring down the pricing. It's not just bringing down, it's more like stabilizing those prices. They wouldn't want to kind of bring down the prices where they kind of, let's say, make these kind of investments run away, because then again the cycle would start where people just won't kind of do the drilling because the pricing is so low. So there is always a balance that government wants to maintain where they want very stable pricing, and then obviously production to keep going so that they can sustain the pricing at that particular level. So that's the ultimate goal. Right now the pricing are much higher than actually they would be. So if you look at natural gas pricing, it's more than $4 right now, and the historic average is $3. So they are kind of looking to kind of bring that particular down, and that's where they're kind of encouraging. But for production like these, I mean, $3 is still a very viable kind of economic prospects where they kind of generate enough income for their investors. And then obviously in terms of the demand, that's kind of keeps on going up. It'll be still a big challenge for government to kind of bring down the pricing for something like natural gas.
We have more questions on similar lines. So, are tax benefits still available if the prices fall or the well underperforms?
Yes, yes. The tax benefit still remains. The income levels can change based on the pricing. So let's say, for example, the well kind of came out with 100 barrel of oil and 100 BBU of gas. Uh, if the gas prices are four, then it'll be $400 versus if it's three, then it's $300. So based on that, you still would keep generating the income out of it, and you would still have the tax benefits associated with it. It's just that the income would fluctuate based on the prices of these instruments.
Okay. And how quickly do these deductions apply? Is it the same tax year? Can I still do it for 2025 with less than 30 days remaining?
Good question. So these investments are generally accelerated in December. So a lot of the projects which we see, they actually come in the last couple of weeks or 3 weeks in December. So let's say if any investor kind of commit to investment in these kind of projects, they generally get the tax deductions. So the goal again, the goal of these kinds of project owners is to kind of get started before March. So the government applied 3 months retrospective kind of criteria on them. So they have to kind of get started in March. So what they do is they raise the capital in December, and then all they have to do is just start the process before March, and they get the investors kind of get the tax benefits for that previous year.
Got it. And can these deductions trigger an audit? Are there any red flags to avoid?
This is very much legal, and this is very much government incentivized projects. There is nothing you are kind of hiding. There's nothing you are doing wrong. It's just you are taking the benefits of the incentivization which government provides for you to kind of invest in the energy infrastructure of the country. So typically, no, there are no audits kind of involved when it comes to kind of investing in this. There can be regular or in general audits if IRS kind of wants to kind of take a look at things closely, but there's nothing wrong in that. Very simple. you receive a very simple kind of 1099 where it shows, you have invested maybe, let's take example with Mike, 200K, and these were the kind of deductions that were associated with it. Bang on. That's it.
Got it. Thank you so much. Rupesh, are these primarily for new projects, or are these opportunities to invest in existing projects also going to qualify for similar tax benefits?
Good question. So projects can be both. It could be something which recently they are looking to kind of drill, but there are some good companies which we generally also kind of work with. They have already kind of started the drilling phase. So once they kind of start the drilling phase, they still need capital to kind of maintain these wells, perform the productions, all those kinds of things. So in this case, the risk is less because the drilling is already started and there is already a validation that the oil and gas is there. So yes, in that case, you just kind of support the capital for the overall infrastructure for production. And you are still kind of using this money for your tax deduction. So it's still kind of considered an active investment and you get the tax deductions out of it. So there can be both. So it depends upon, the kind of project you choose ultimately.
Okay, this is an interesting one. So don't give me the average, but more realistic expectation on returns. Don't give me the best, but an average realistic expectation on returns for an investment like this.
Yeah, I mean, so we have covered mostly the base case for oil and gas. So let's take a very simple example. Right now, the pricing is for oil is $60, natural gas is $4. So the model generally keep in mind that what's the historical kind of average for these particular assets. Again, for the the price is around $55, which is historical average. And for gas, it's around $3. So this is the kind of criteria we kind of generally model in for these particular numbers to kind of showing. Now, let's say if the oil prices were to kind of go down by maybe let's say 20%. So if they go down to for roughly $40 a barrel, so correspondingly, your income would kind of reduce from maybe 40% IRR for the initial 2 years to 30% IRR. Same case with if kind of gas prices goes down as well. So it depends again on the pricing. That's a factor, obviously, that remains. That's a risk that remains. So you just cut down the percentage of the kind of decline within the oil and gas prices to your percentage IRR returns, and that's where you can get these numbers. But it's not a complete kind of true reflection, and it's not kind of one-to-one mapping here is because a lot of these producers are very smart when it comes to kind of when the pricing is kind of lower. So what they do is they kind of reduce the production a bit during that particular time. They have the switch. They don't want to kind of produce too much to kind of sell in a market where the pricing is low. So they kind of lower the production. So in such cases, you would see more kind of output in the later part of the years when the price kind of also improves a bit. So that's how they kind of manage the overall dynamics as well in terms of the pricing so that the investors kind of get the maximum out of the production which they are kind of doing.
Okay, I'll take these two together. Would this make sense only in a, would this investment make sense at all in a low income year or only in a high tax year, like my RSUs vesting or something like that? And how much do I realistically need to invest for this to be actually worthwhile?
Okay. So in terms of when is the right investment, when is this a right investment for you? It's generally in a high tax year. So typically we recommend if you are coming in the tax bracket of overall above 30%, that's when it's ideal for you because you get very strong kind of upfront payment because of the tax deductions. And then the compounding effect is enough for you to kind of cover or kind of do a more favorable risk return factoring for you. So to answer, yes, high income years is the year when you should be kind of looking for something like this. In terms of how much you should be kind of investing, it totally depends upon your income and how much you are kind of looking to offset. We have seen cases where people want to kind of invest as much as possible and sometimes through their savings as well. So let's say if they had 600K of income, they would invest as high as 300K to offset 300K of income, which puts them in a lower tax bracket and save significant in the taxes, and then keeps on generating income out of that as well. Versus someone who just wants very smaller kind of tax reduction and don't want to take too risk in oil and gas investing, they would invest maybe let's say like 100K only to offset that much amount in their W2, and then kind of reap benefits out of it in terms of income generation throughout. And a lot of these folks do it on a year basis because people have high incomes consistently throughout the years. And someone starts like, let's say in 2025, and then they do another project in 2026 of similar amount. So they kind of keep on diversifying their years as well to kind of offset the income throughout those years where they are kind of earning.
Okay. And historically, how often do wells actually fail?
That's again a good question. So historically, the rate has been around 70 to 80% in terms of the success rate, but that's pretty much the past. Today, the technology is so good that sometimes the rate is for a particular company or a project is as high as 99.9% because there is so much surety in terms of the geological aspect of the reserves that are there within that particular space. And we generally recommend to work with folks who have this kind of technology, who understand these kind of dynamics. And a lot of these people, as I kind of mentioned, are in the phase where they have already drilled. They know there are reserves, they have proven it, and they've already started the reserves drilling. They just need your money for capital support and maintenance, basically.
Is the income that I get monthly, quarterly, or is it irregular?
It's monthly. It's monthly.
Okay. And what is the best time of the year to analyze or invest in this project?
Um, any day is best day as long as you do it before December 31. You're good to go. But generally, these investments take time to kind of, you know, understanding of these particular investments is very, very important. So earlier the better, because in that way you can kind of also plan your taxes throughout the year as well, in terms of how much you would be getting, how much you need to kind of put forward, how much do you need to kind of invest. And it's not just about tax benefits, although you would get the tax benefit, but it's also about, start getting generating the income through these kind of projects as well. And this is a passive income that's helpful for you in many possible ways in fulfilling your dreams as well. So there is no kind of perfect time to kind of do that. If you're looking for tax perspectives, maybe December is the best year. But in general, for diversification, income generation, and overall tax planning throughout the year, earlier the better.
Okay. We'll take the last two questions and the rest of the questions we're going to send over in the follow-up email. So, should this be considered a one-time tactic or a recurring annual strategy?
Yeah, good question again. So it totally depends upon you. It could be one term, if the project is too good, it could be a one-time kind of investment where you kind of put in a good amount of money out of your pocket and offset your W2 income. Or there are like a lot of opportunities coming up, which a lot of projects that are coming to you throughout the year. Then you can kind of diversify it with different players and kind of invest in, let's say, smaller chunks than you would kind of do one-time kind of investment. So it depends upon the volume of the projects, volume of the good projects that you are kind of receiving, and how much tax benefits you are looking to kind of reap in ultimately.
Okay. And the last question we'll be taking up here is how long does it take from investment to first tax benefit and then to the first income?
Okay. So once you kind of invest, that's the same day you kind of use this as a tax deduction kind of metric for yourself. So generally what we have seen is, so let's say if you invest in December, let's say if you invest today, that particular 100K. So when you would be kind of doing your tax filing in April, that's when you would be kind of saying, hey, I kind of invested 100K in this, reduce your taxable income, and you get basically a refund if you have already paid the taxes, or you don't pay anything if you owe any taxes. So that's immediately benefit to you in terms of the taxes. In terms of the income generation, once you kind of invest in, so as I kind of mentioned, it's a 9 to 12 month kind of drilling process. So once they have the capital, they start the drilling process further, they start the production, and it takes around a year for them to kind of start selling this particular oil. So after that particular year, you kind of start seeing the income generation on a monthly basis from these particular productions.
Okay. We'll be wrapping up. Thanks a lot for your time and insights, Rupesh. For everyone, if you're already working with an advisor, these are the type of questions that you should be asking them and evaluating this investment before end of year. And if you'd like to do a deep dive with Alfonso Advisors or just connect with Rupesh directly, here is a QR code that you can scan, which will lead you to a form on our website. You can fill that in and discuss this in more details. Having said that, thanks again for your time. And if you have questions, we're always just a tap away. Thank you all.
Thank you, guys.